Good to have you here. I think you
Thanks
walked
for
in.
having
It's good to have you back, Don. I think I said you walked in. I said I feel like every time you walk in, there's something going on.
Good timing on your side, at least.
It is. It is. Thank you. Sometimes we're just lucky, and we are lucky to have you. What do you make of Strait of Hormuz seeing its biggest day of attack since the Iran and U.S. peace deal? We have the U.S. Treasury Department revoking that waiver that allowed the sale of Iranian oil. We've seen oil prices pop up on this. I get it. It's logical. Is all not over when it comes to our concerns in the Middle East? How do you guys?
It's an important reminder that the downside risks to Middle Eastern supply and the upside risks to oil prices remain very significant. While the interim peace deal is an important step forward, and while oil flows from the Persian Gulf have picked up to about 75% of normal levels, if you include pipelines, a lot of outstanding issues are not resolved. Sanctions, management of the strait, including fees, investments in the region. So we'll have to see how the negotiations go. I think it's a reasonable base case for markets to price in a recovery in Middle Eastern supply, but the risks are still very significant. I think that markets had priced in perhaps with excessive confidence the recovery in supply and perhaps extrapolated to the base case of surplus in 2027, but it's still a highly uncertain environment.
How are you thinking about supply? I think it was just yesterday.
Saudi Aramco that we talked about.
Is there a glut in the market or not?
So I think in the short term, the fact that some of these oil futures curves are in contango, meaning that prices today are cheaper than the price to get a barrel tomorrow, does suggest that temporarily, at least there is an excess amount of supply. Why is that? It's because we're seeing a pickup in export flows that's pretty quick, mostly oil that was produced before, while demand from China is still weak. If you look at import demand from China, it is still down a staggering 5 million barrels per day year over year, which is a 50% drop year over year. So at least in the short term, because it will take time for China demand to recover, and as it's easy to get previously produced oil out, I think temporarily you have a bit of an oversupply. But the pickup in exports doesn't mean that production is necessarily already back and will be higher on a sustained basis.
Are we right on to assume China is going to resume all of the oil production pre this war? Because there's been some narrative around that they didn't love how vulnerable they were, right? We know that they don't produce their own, and so they are reliant on imports and oil, and they have been aggressively moving into alternative energy. So are we wrong to assume that they're going to come back and start buying like they were?
I think the largest oil supply shock ever, the Hormuz shock, will validate the Chinese strategy to diversify into other energy sources and to continue to stockpile. I do think that the weakness we're seeing right now in China crude imports is not sustainable. The fact that you reduce your crude imports by about 5 million barrels per day reflects both destocking, which is, I think, not in line with their long-term agenda to have higher stockpiles. And it also reflects weakness in end-use demand, burning oil for consumption. History suggests that once the availability and affordability of oil products improves, that end-use demand should recover, at least partly. We expect that about 90% of the weakness in oil demand in the second quarter unwinds in the next couple of quarters. But we have some lasting damage, especially in China, where EV sales have surged. Actually, globally, the share of EV cars in global car sales has picked up by about 4 percentage points since the start of the war. So there will be some lasting demand damage, but we think that the extreme weakness in China import demand is mostly temporary.
Okay, so lasting damage, but something that boosts renewable energy?
I think this shock reinforces our views that are structurally bullish on demand for power, demand for copper, demand for battery metals.
Yes, and yes, right?
Yes, and probably also coal, because you can make coal in China. You can make coal in India. It's positive for all the energy and commodity sources made in China, made in India, where you can reduce your import reliance.
The Brent crude annual average price was $69.14 per barrel in 2025. In 2026, it has averaged noticeably higher, surging past $100 per BBL in the spring before tapering to roughly $85 per BBL in June. Overall 2026 averages are forecast differently across institutions, ranging from $60 to $91 per barrel.
Welcome back. Oil prices are below $77 a barrel. Take a look at $76.68 as planned talks in Switzerland over the Iran deal have been postponed. Vice President J.D. Vance will not be traveling to Switzerland today as planned. But the vice president says 12.5 million barrels of oil have already moved through the Strait of Hormuz in one day. Watch.
12.5 million barrels of oil went through the Strait of Hormuz. That is a high since the beginning of the conflict. Oil prices are down nearly at their level from the pre-war conflict. Gas prices dropped below $4 a gallon today for the first time since the conflict. So far, they are honoring their end of the commitment. And on the blockade, CENTCOM has allowed north of a dozen ships to go through our naval blockade, and so we're also honoring our end of the early part of the agreement.
Joining me now is United Refining Company and Red Apple Group Chairman and CEO John Catsimatidis. John, good to see you. Thank you so much for being here. And this comes after the Federal Reserve kept rates steady this week. Your thoughts on where oil goes next?
Well, I mean, we've been predicting it right for the last couple of years, Maria. And we did say 30, 60 days ago, the minute the Strait of Hormuz opens up, and it's opened up, that the price is going to drop $20 a barrel. And now, yesterday it was as low as 74. I guess they're taking the weekend off. And Monday morning, I think the next stop for oil is probably $65 a barrel. And the price of gasoline in the United States should go down to under $3 a gallon. And energy costs will go down. Now, the other thing is interest rates. Now, interest rates, I mean, there's all kinds of people that are putting pressure on interest rates. They're going to go up. They're going to go up. They're going to do this. They're going to do that. Well, the new chairman, I believe he's committed to do the right thing, and that the interest rates will go down because, you know, everybody's talking about.
Hold on. John Schott is obviously shaky, but listen to what he just said. A minute ago, he said that he thinks oil, the next stop is $65 a barrel. Crude is at $76.68, and John Catsimatidis is expecting this decline to keep going to 65, Cheryl.
By the fall, that is a very realistic range for oil. And look, that's where we were before the conflict began. If the strait stays open, if the Iranians continue, of course, or at least not try to toll ships that are going through there, that'll be obviously a win for the Trump administration. The market, though, has been calm, cool, and collected through this entire conflict, Marie. And I think that's been evident in the record after record that we have seen for the Dow, the S&P, for the NASDAQ. And again, with oil prices, I mean, because look, we dropped, what, $15 the minute that things got better, and we looked like we had a deal between the Trump administration and Iran. So, look, the market's on fire, Marie. You've talked about it. We've had quite the rally with so many pieces of good news. And if this 60-day ceasefire, this agreement holds, this memorandum of understanding, it stays in place, then $60, absolutely. I agree with Katz.
I think, Todd, this 60-day period is really what we need to be watching and how the Iranians react. I mean, we saw what Khomeini said. He's obviously at odds with the president of Iran, who wants to move forward and do a deal with President Trump and the administration. Your reaction? Yeah,
it does call into question the staying power of this deal, like who's in charge, who signed it. Right. I think all those things are still open questions. For me, this was a necessary move to kind of show the world, hey, we can lower prices. But again, Maria, my concern, none of this matters if prices are still high heading into early voting in October. Because let's face it, you can't really impact inflation in any other area. It's not like eggs are falling to $1, right? That's not going to happen. Gas, you can. And you have to give the American voter something tangible. That's why this was a shrewd move, but it needs to stay a shrewd move between now and November. And my fear is that if we go back to fighting, it's not going to improve. It's going to get worse. And, that's going to hurt Republicans come November.
Yeah.